How are you doing? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world. And what we're going to talk about is the downside of buying the dip. And why this is going to be a really relevant discussion or conversation for you today is that the stock market, the overall stock market has been in a downturn pretty much, what are we going into, like maybe the 11th month of the year. So this kind of started in November. It's been going down month after month. We had a few relief rallies, a little bit of a recovery, and then we kind of repeated that same process. And many people are worried about their 401k account. They're worried about continuing to invest in the overall market. And what we're going to talk about is the downside of buying the dip, because for a very long time, we were told when the market goes down, all you need to do is buy the dip and ride it back up. And this was considered a kind of like a normal market narrative. And what we're going to kind of go into is my perspective on this particular narrative. I'm not an investment advisor. I would encourage you to reach out to a professional person that is qualified to advise you in the area of investment. What I will do is give you my opinion based on my understanding of the market, and I understand more about how the actual financial market works than 99% of the population, even many of the people that have gone to school and passed a particular test. So that's who this video is going to be for. But really quickly, the sponsor of the show is www.thehighestpaid.online. That is an options trading academy designed to help three people in our particular society. The person that's upset that they make a certain amount of money working a 9 to 5, and they don't see a way to make more money. We talked about yesterday, the credit solutionist talked about people that are overemployed, what we used to call moonlighting, and how that got them in trouble with their particular employer, and how they're going to start looking for that, right? The person that doesn't like the fact that they got to take a lot of time away from their family to make the money that they make. So as a trader, I make the majority of their money in my home, but also can do it mobily because of technology. The average person that has to commute and travel to make the money that they make, they're not necessarily liking that. And also the fact that even though we're in a high inflation environment, the costs are going up, they won't get a raise until 2023. If they do get a raise, and then maybe that 5% raise won't cover their expenses, and they don't necessarily know how to make more money. We figured out how to solve that problem, teaching people how to leverage the actual options market. It's not an overnight situation, but we have been successful in teaching people how to leverage essentially hedging instruments to generate more income to solve a lot of those particular problems. And we've been successful in solving that problem. And that's, to me, what separates us from the majority of people that are actually just talking on YouTube. We have real life results in this particular area for people that have stuck to the curriculum, been successful. And some of those people have spun off and started their own thing, which is a beautiful thing because the goal is to make this grow and to provide this solution to more and more people. So that's the sponsor of the show. Let's get back to the particular commentary. And so what we're talking about is, let me put that banner up real quick. The downside of buying a dip, not investment advice, right? So I want to understand that. Now, what we've seen over the past year is this market has been selling off really aggressively, right? So this is around November of last year, and we've sold all the way down. And a lot of people are getting shaken out of their investment accounts. They're getting shaken out of their funds because they don't necessarily understand what's going on, and they don't understand what they can do about it. So they're seeing their 401k be negative over the course of this year. The question we want to ask is, should you keep buying a dip in the market? Because common advice in this area is that you're going to be in the market for an extended period of time. Therefore, this short-term downturn isn't anything that you need to be worried about. And then therefore, if you're going to be in the market, you're not looking to retire for another 10 years. You're not looking to retire for another 15 years. Therefore, you shouldn't worry about this yearly downturn, because what a lot of people are trained is that the downturns of the market are going to just last short term. You know, a correction, I think, is anything over 10%. It might be anything over 20%. They're taught that any downturn is going to be short term. Therefore, if you buy the downturns, you can ride it back up. What we're in now is an extended downturn. And many people, based on their professional education, they're not trained for this scenario, is because this is a minority of time that we're in the market. And if you go pull the market back on a 5-year, or you go pull the market back on a max term, we're looking at the S&P 500, what you'll see is that the market just keeps going up, right? So if you look at this market from 2009 is when we had the first downturn because of the real estate crisis. We hit this bottom and we rolled all the way up. We had another downturn in 2018. Here's a pandemic downturn. So from 2009, let's say you're starting investing in 2009, from 2009 to 2018, then from 2018 to 2022, we were at 4,000, but in 2009, you started off at around 800. So you started off under 1,000. So you had great gains over this particular time. So the common narrative is always just keep buying whatever downturn it is. right? Buy the dip, buy the dip, buy the dip. And it worked for a very, very long time. One of the things about the market is that people have to understand it. And this is for people that actually trade and understand the market, is that just because something has worked before doesn't mean it's going to work now. And this is what they tell you anytime you look at a prospectus, is that future performance is not a guarantee. I'm sorry, past performance is not a guarantee of future performance. Just because a particular strategy has worked in the market for the past 40 years doesn't mean it's going to work this year, right? 60-40 bond to stocks. I'm sorry, 60-40 stocks to bonds has worked forever. It's not working this year, right? Because historically what you would do is people would invest 60-40 stocks to bonds. And if the stock market was going up, historically, the stock market was going down, historically, the bond market would go up. Let me slow down because I'm talking too fast. So historically, if the stock market was going down, the bond market would go up. And then what they would do is they would encourage people, as you got closer to retirement, you would take your money out of stocks, which are more volatile. You would stick your money into bonds, which would be safer. And then over time, you would liquidate your bond position. What we saw during the pandemic is that money moved from the stock market, moved into the bond market, and then money started to leave the bond market because there was a lot of distress in the market and we were in a massive risk-off event, right? What we see now is that money is moving out of both markets. And if the Federal Reserve doesn't come in and support the bond market, we may not get a lot of movement in the bond market the same way that the Bank of England had to come in and support their bond market, because if everybody's selling but nobody's buying, then we don't have a market, which means that yields spike, but we still can't find buyers. And the government doesn't want treasury yields to go up to a particular level to where now the government's going to be on the hook to pay back treasuries at 25, 30, 40% because it'll destroy the American economy. So you have to understand is that just because something has worked historically, it doesn't mean that it's going to work in the future. And when you're going to an advisor, they've been trained and they've been tested on what has worked historically. But as people that actually understand how to trade the market, just because 60-40 was an edge for the past 50 years doesn't mean it's an edge this year. And it doesn't mean it'll be an edge into the future, because the market is very volatile by nature. The market is very dynamic, and it doesn't mean that something's going to always work. But this is for people that actually trade. Investment advisors who I'm recommending that you go to are not traders. They've been taught a certain format and a certain template around investing. They've been taught a certain format and a certain template around trying to get people to prepare themselves for retirement, and they just work that playbook. But they don't have any new plays. So let me give an example. Me and Drop 16, who I know played football back in the day, we work on a set number of plays from an offensive standpoint all week. And we show up at the game with those plays. First play of the game, the quarterback breaks his leg. We now got to come up with some new plays because the second string quarterback can't do what the first string quarterback did. What we can't do is try to make the second string quarterback run the same plays the first string quarterback run, because why? He can't do those plays, right? And so you can see this a lot of times in scenarios where we have a playbook or a template that we've been running for the past 25, 30 years. Those plays won't work right now. And this is why you see a lot of teams struggle in sports. Let's take football, for example. When they lose their top guy, the question is, can what the second guy do run what we've been running? We saw this with Dallas. They brought the second string quarterback in. He was able to run what they've been running. Now they're talking about they don't want Dak Prescott back. Why? We don't need him because the second guy can do what we needed it to do. If the second guy couldn't run the plays, then we got to get Dak back as fast as possible. Why? Because everything that we built doesn't work with this new guy. And we don't want to change our whole offense for this new quarterback. And that's what I want people to understand. So what we've been trained to do in this market is keep buying the dip, stick to the 60-40 stock to bonds, and everything will work out over time. Well, that hasn't worked this year. And what we're going to talk about a little bit later is that the average person doesn't even understand what they're doing in the market. They've been taught to just take advice from somebody else, and they have no idea what's going on, but they're watching their assets being eaten up by this market, and they don't even know why it's happening. And I think that is one of the downturns in which we educate people for this particular space. And we're going to get into that a little bit later, right? So common advice from professionals would be the dollar cost average into the downtrend, right? That would be common advice from professionals, just dollar cost average into the downtrend, right? So what are the benefits of dollar cost averaging? Dollar cost averaging creates investing discipline, it uses time and consistency as your advantage. So what I do like about dollar cost averaging is that it gets you to invest at a regular pattern. And that's going to be the problem for most people. Most people, their investing is going to be very random and sporadic, right? So that's the issue. What dollar cost averaging teaches people to do is invest every month, every quarter, every 2 weeks. And so that's one of the benefits of being in a 401k or being in a mutual fund in which they automatically take the money out of your check is it's very consistent. Because if you're going to utilize dollar cost averaging and you're also going to utilize a 401k or a mutual fund, which is really a 401k, you need to be consistent with it. When you stop doing it is when you start having issues. So it's a consistency over time, because anytime you invested in any market, but especially the equities market, time is going to be your friend, right? Time is going to be your friend, because most people aren't going to be making so much money to where they can put $100,000 in one quarter and then take 2 quarters off and in the next quarter put in $100,000. They don't make that kind of money. However, dollar cost averaging is promoted by mutual funds because they make money on assets under management and they need inflows. Therefore, anytime you're looking at a mutual fund, which is your 401k, no one's going to be based around some type of mutual fund. They make money on assets under management, right? Well, I can't really go into this because it's really not the topic of the conversation. The average retail investor doesn't really have access to any asset classes except mutual funds, right? That's just the issue. Now, that's a larger issue of a larger scope, has a lot to do with structure of society. So unless the average investor starts, educating themselves on real estate, other asset classes, the only thing that a financial advisor, certified financial professional, is going to tell them to do is spit your money into a 401k, hope that your job matches it at a certain percentage, Roth, IRA, things of that nature, right? Really based on an overall market. And you're not going to be exposed to anything else. And like I said, that's a byproduct of their education. Mutual funds going to always promote dollar cost averaging. Why? Because it keeps money going into the particular fund. And they get paid on assets under management, and they need inflows. Therefore, they want you to keep investing. It's not that it's a negative thing, is that's the best thing for their business. It's also the best thing for you if you're long term. And I'm here to tell you, from my opinion, investing in a 401k is better than having nothing at the end of the day, right? Because most people will not have the discipline over the course of their life to learn about different asset classes and put money in those. That's going to be a minority of the population. It has a lot to do with socialization. So let's really quickly talk about a really quick video on dollar cost averaging. And is it better to lump sum investing? But most people are not going to be a good candidate for lump sum investing because the average person is not going to come into a large amount of money at one time. But let's really quickly get into a better understanding of what dollar cost averaging is. So let's watch this video on it.
Say you've got a chunk of money you want to invest. Is it better to put it to work in the market all at once or to buy gradually over time? I'm Cameron May, and this is Comment Below. Brandon Lowe commented, "Great content." Hey, thanks, Brandon. I hope you can do a video comparing dollar cost averaging and lump sum investing. Which are better performers in the long run? Well, Brandon, the debate between dollar cost averaging and lump sum investing is a long one. Let's look at each side. Dollar cost averaging is continuously investing the same amount of money in a security over time, regardless of fluctuating prices, rather than the entire amount all at once. For example, if you wanted to invest $1,000 in shares of stock that's currently trading at $50 per share, you could break it up into 5 increments of $200 to purchase shares at regular intervals. Let's say you were able to purchase shares at $50 and $48, $47, $51, and $52 over a period of time. Your average price per share would be $49.60. On average, this saves you 40 cents per share compared to the $50 initial stock price if you had bought it all at once. There are a couple of benefits to this. First, you have a psychological benefit of not risking the entire amount immediately and having the anxiety associated with the stock falling. Second, if the stock falls after your first purchase, you're only losing on a small amount and the pain is less. Third, as you saw with the example, buying over time could bring down your average cost per share if the stock drops. However, there are risks. If the stock price rises over time, you're buying at a higher price, which will increase your average price per share. Not to mention missing out on possible gains if you'd invested the full amount at the beginning. Of course, if the stock price falls over time, you'll keep buying at lower prices, but there's no guarantee the stock will go back up. Also, investors who practice frequent dollar cost averaging may generate additional trading costs, commissions, and other transaction costs that outweigh any cost benefit. Another approach is lump sum investing, which is the immediate investment into a security using all available funds. So going back to the earlier example, it'd mean investing the full $1,000 at once for $50 per share. If the stock rises, you're all in and you get all the benefits. If the stock falls, you're all in and you get all the losses. Over the years, investors and scholars have studied these strategies with mixed results. The winning strategy varied based on factors like time frame, whether the results were adjusted for risk, and how performance was measured. For example, check out this chart from a 2020 study, which compares the performance of dollar cost averaging versus lump sum investing over time. When the line is above the zero level, dollar cost averaging is outperforming lump sum investing. When the line is below the zero level, lump sum is outperforming. So either strategy may outperform at a given time. Because the line spends more time under the zero level, lump sum is more often the winner. However, this chart doesn't account for the risk associated with each strategy. Let's look at the standard deviation of returns for the two strategies. Standard deviation, defined as a measurement of the average absolute deviation from the mean, is a measure of volatility or risk. The chart shows that lump sum investing has greater volatility, which means it has greater risk than dollar cost averaging. So what does this all mean? First, which strategy is the best will depend on market conditions. Not surprisingly, lump sum investing has historically performed better during bull markets than bear markets. Second, the better strategy depends on your risk tolerance. If you forecast a bull market and you have a higher risk tolerance, lump sum investing is likely the better choice. However, if you're forecasting volatility and you're risk averse, then dollar cost averaging may make the most sense. Of course, dollar cost averaging is only one way to manage risk in a portfolio. Lump sum investors can potentially lower their risk and increase their returns by rebalancing their portfolios. Rebalancing is the process of selling some of an outperforming asset and using the proceeds to invest in underperforming assets in order to maintain a preferred investment mix.
My bad on the audio. So that's a basic understanding of dollar cost averaging. I wanted to get out of there once you started getting into rebalancing because that's more of an advanced skill and the average person doesn't even understand how to do that. So that was kind of outside the context of the particular video. But you got to really understand is that dollar cost averaging can work for you, and it also cannot work. But what I want to really talk about is this right here. What are you investing in? So one of the things that I want to do and one of the things that motivate me is to get people to have a better understanding of their money and to get past just budgeting and saving. There's a level past that. And why am I inspired to do that? So I come out of the healthcare space, right? There was a time in healthcare to where you would go to the doctor and whatever they would tell you to do, you just would do it because you didn't understand what they were talking about. A lot of the information that they had access to wasn't available on the internet. Everything was available in print. You had to go to sometimes college libraries to get these medical journals. So the average person didn't know anything about their healthcare. And what we found is that over time, a lot of people were very dissatisfied with the care that they were getting from their physician, but they didn't necessarily have the information to come into the office and have a very thorough and rigorous discussion about their care and their protocols because they didn't have the information that the physician had. We're now in a different environment to where you as the regular consumer can get access to the same information that the physician has. Therefore, if you have a common ailment like diabetes, or you have some type of disease that is serious, you now can come into the particular meeting with your physician, even though you don't know what they know, right? Because they've gone to school and they've done a lot of studying, but you have a basic understanding of one, what is going on with you, and then what possibilities do you have from a treatment standpoint, right? And it's changed the whole medical space. You have doctors now that just specialize in giving an alternative point of view around medicine that's not the mainstream because we produce a lot of doctors in our society where all they know how to do is tell you to take medicine. I know that for a fact. I had massive tendonitis as a basketball player. Every general practitioner I went to just told me to take anti-inflammatories, which is not a solution to my problem. I had to go to a sports doctor to get a real protocol to solve my particular problem. And this was a serious problem. I would play ball and my knees were hurt for 2 weeks. And it was just inflammation. But nobody had a solution to it. It was just give you some more drugs to manage the inflammation. But we need to deal with what's causing the inflammation because in reality, I'm putting micro tears in my tendons, which over time is going to make my tendon pop. But you got to understand, I had to come in with the information to ask the questions to realize I'm going to the wrong people to get a solution which led me to go into a sports physician who actually understood how to work with athletes. General practitioners, even though they were tested, even though they were licensed, they didn't understand how to work with an athlete. They just understood how to work with people that were sick. And primarily, most general practitioners only know how to work with an older population. Most young people don't go to doctors. So my goal is to get people to understand their finances from a standpoint of they may not be quote unquote experts, but they can ask questions because they're informed that can help them get better results. So the question is, if you're invested in the overall index, if you go into a mutual fund, if you go into a 401k, most likely they're going to sink you into an overall index fund. Certified financial planners have told you to just do index funds. The question is, if you're in an index fund, what are you investing in? Right? If you're in an index fund, what are you investing in? You're not investing in an index fund. That's the name. Right? So if you're in an index fund, that's not the same index fund it was 10 years ago. Therefore, if you're in an index fund, what are you actually investing in? Right? What is it? Right? What is it composed of? So the question is, S&P 500, what is that? So the chart is of the S&P 500. What is this a chart of, though? Right? What is the S&P 500? You're in the NASDAQ. What are you investing in? People tell you, well, I'm invested in tech. I invested in, tech. I'm in the NASDAQ, or I'm in the Qs. I'm invested in tech. What is that? What are you invested in? Second question, do you know where your money's going? So if you don't know what you're invested in, do you know where your money's going? Right? So what is the S&P 500? What is it composed of? Right? Most people don't know that. This is the questions I want to start helping people be able to ask. Now, they know the answer, but they should be able to ask those questions. So when a certified financial planner tells you, I believe you should invest in an index fund, why do you believe I should invest in an index fund? What's the advantage of investing in an index fund over investing in a managed portfolio? Right? What's the advantage of it? Why do you think, based on your training, that that's going to be a solution to my problem? That's going to help me arrive at my goals. The same way, if I go to a doctor and I say, hey, I got knee tendonitis from playing ball, and he says, well, you know what? You should just take a leave before you play, and then you should take a leave after you play. Okay, why do you think that's a solution to my tendonitis? Because all I'm taking is an anti-inflammatory. Anti-inflammatories don't stop inflammation. What they do is they stop the signal from your brain to tell your body to produce inflammation. But you know what? Your body producing inflammation is what your body's supposed to do. But see, if you don't study, you don't know that. Your body's supposed to produce inflammation. The question is, why is your body producing inflammation? Because inflammation is part of a healing process. Right? So if all I do is take the drug to stop the chemical, right, from my brain, really coming from my pituitary gland, to tell my body to produce inflammation to protect my knee tendons, but I'm still doing the thing that's causing the inflammation, I'm setting myself up for a big downfall later. But if I don't know that, then I don't know to ask those questions. Therefore, if you're dealing with a certified financial planner, you're dealing with a tax advisor, you're dealing with a person that's going to help you retire, and they're telling you, well, you should just put your money in the index fund. Why do you believe that? Based on your professional recommendation, how is that going to help me get to this particular solution? And you know the difference between an index fund, you know the difference between a managed fund, you know what emerging markets are, things of that nature. Why do you think I should just invest in the overall U.S. economy based on your analysis? And then y'all have a discussion around that allows you to understand where this person's coming from, so they're not just giving you something that's templated, okay? So my biggest critique of dollar cost averaging is that the average person is hoping and wishing that the magic of the market will make them successful. The average person doesn't know how these markets work. They don't understand how they function. And they think the magic of the market is just going to make them successful long term, right? Yes, it's true over long term, and we just showed with the chart that the market keeps going up. Why does that happen? What are the conditions? So, because like I told people before, if you don't know how you make money, you don't know why you're losing money, right? And that's what I'm really trying to get people to understand that. There is no magic way to make money in this world. Therefore, if you don't know how you're making the money, so if you're putting money in your 401k and the 401k keeps going up, but you don't know why that's taking place, when the 401k starts going down, you don't know why it's going down. But because we've created so many people and taught them, just like we used to have in medicine, that this space isn't for you to understand. You're just supposed to go to the quote unquote experts and let them do everything. And you just have so much faith in them like I said before, is you're putting yourself in a bad situation. The same way when you go in medicine. I don't know more than a doctor, but I do know enough to ask certain questions around what's going on, because I'm here to tell you, the doctors had no solution to my tendonitis. So I was in pain all the time, but they had no solution to it. What they were telling me to do was not a solution to my problem, right? Because I was in pain all the time. So I had to do the research and do the study to figure out how to solve this problem. I haven't had a tendonitis problem in pretty much like 7-8 years, but I had a 3-year run in tendonitis. I had a bursa sac infection. That's how bad my tendonitis got, doing what doctors told me to do. You know, all to take the rest and the ice and all that stuff. None of that is a solution to tendonitis. Your tendonitis is being caused by certain things. But like I said, they've been trained that anti-inflammatories are a solution to tendonitis because they're not used to working with athletes. They're used to working with the average ham and egg person that has tendonitis because of maybe a little bit of overuse. They take the anti-inflammatories, they rest, and everything, you know, straightens itself out. If you're a very active, engaged person, anti-inflammatories are not a solution to tendonitis. But the average doctor doesn't deal with athletes. They deal with an older audience or a person that just has a little bit of an overuse issue. So that's what I want people to understand. One of my goals is to help just a regular person get a better understanding of how money works, the financial space. Therefore, when you sit down with these people, you can ask the right questions, right, around what they're telling you to do with your money. Because it's your money at the end of the day, it's your retirement, it's the future of yourself, it's the future of your family. And I want you to be a little bit more informed around that particular issue. So that's all we're going to talk about today. We're not going to really be here long. So we're going to go through these comments. I got some super chats. We're going to read them out. We're going to get up and out of here. Callie Laws, man, I really appreciate the $5, man. Appreciate it. Greg, your mama, appreciate the $4.99, $5. Miss Lady L, what's going on? LH, you said you move your Roth 401 to a money market fund. Not sure if that was a good idea, but the outcomes look better. So I would speak to you, my financial advisor, around doing that. And just, you know, what do you think? But the question is, and I'm not talking about you, but the average person, what's in the Roth 401k? What is it composed of? What's in the money market fund? What is that composed of? How does that work? Are there going to be tax limitations or tax obligations based around that? And like I said, you don't have to be the preeminent expert around it, but you have a basic understanding of what's going on with these particular situations. So you can sit down with a professional and actually ask them questions around what's going on instead of them just feeding somebody something and you just doing it because they've been trained to think that's the best way to do it. Right? So Drop 16 says, ever since reading how the Fed has changed their strategy for controlling interest rates since the USD was backed by gold, so things can always change in monetary policy. Definitely. Yeah, we're in a new regime. Over the past literally 20 years, we've been doing easy money policy. We're in a new regime now. So the way things work don't work anyway. Now people are hoping we're going to go back to that same policy. But currently right now, we're in a new regime. And that's why what has worked for so long isn't working right now. So I notice a lot of people are afraid to ask questions, even many with highly formalized education. And I can understand that. Many times we're not taught how to ask questions. And a lot of times we may not feel like we know enough about the space to ask the right question. That's why I tell people, you should come in with just a basic understanding of the area and what these things are based around, you know, because you can go look up on the internet. If you're dealing with a certified financial planner, what is their job? What are they going to do for you? So that you understand what direction they're going to try to turn you into, even though they say that everything is going to be specialized, it's really not, you know, it's really not. It's really templated. So each sense says that I think the average person doesn't want to take active role in managing their money because they're extremely tired from the day-to-day job. And I 100% agree. And that's, like I said, how this society is constructed. It's constructed in a way in which you don't feel that you have the energy to worry about these things. And so you hand it to somebody else. But the problem is you're going to be responsible for it at the end of the day. So if they're wrong, it doesn't mean that you can sue them. Like, so a certified financial planner has been trained to not tell you things in their own interest. It doesn't mean that they're right, though. So people understand the difference between the two. I may not be trying to act in my interest in giving you advice, but it still doesn't mean my advice is right. And I think people don't understand that. So they try to use it as a calling card. Well, unlike somebody that's selling you insurance or like somebody that's trying to get you to a mutual fund, I'm not looking to sell you a product, but it still doesn't mean that your advice is correct. It just means you're not looking to sell me a product. And that's what I want people to understand. That's why if you can go in with a basic understanding of what they're going to tell you to do, and then you can ask questions based around that, based on, well, how does this help me get my goals? Why are you suggesting this as opposed to suggesting something else? And if they don't want to explain that, you're with the wrong person, because you're paying that person to give you an understanding of the scenario. I wouldn't pay them just to give me a template, right? But I 100% agree with you. And this is not the scope of the video, but the way this society is constructed is to make people easy to manage, right? Because if you had 20 million people like me, there'd be wars in this country, because I'm not going for it. But the way in which they built this society is they need people easy to manage. So yeah, you're tired, you're working really hard, you're overworked and underpaid. So you just putting money away in this 401k or putting money away in this particular fund, hoping that it's going to be something when you retire. But you don't even understand the mechanism that works to help create something for you down the road. Like, how does this even work? Don't know, right? But that's a really good comment. So we're going to get on out of here. I told you we weren't going to be here long. It's a short video. David W. Williams, also known as Diamond Dave. I'll talk to you later.